The recent surge in oil prices is driven by multiple factors, including drone attacks in Russia, Middle East unrest, and the strong consumer demand. This has led to Brent crude surpassing $90 a barrel for the first time since October. Gasoline prices have risen significantly with potential for further increases, especially ahead of the summer driving season and amidst the presidential election year. The question stands, how far is this aimed at? Hi everybody. The rise in oil prices complicates matter for the Federal Reserve as it can contribute to consumer price inflation. Despite some uncertainties such as diesel demand and the strength of the dollar, analysts predict continued upward pressure on oil prices, potentially reaching $95 to $1,000 per barrel. Factors such as production cuts by OPEC Plus and geopolitical tensions, including Ukrainian strikes on Russian refining facilities, are contributing to these forecasts. First of all, let's understand how have production cuts by OPEC and its allies impacted global oil supply and prices. Under the graph, let's understand the supply and demand in the oil market. On the horizontal axis, we have quantity of oil, and on the vertical axis, we have price of oil. Initially, we have a supply curve and a demand curve intersecting at a point A, representing the equilibrium price and quantity of oil in the absence of OPEC plus production cuts. At this point, the equilibrium quantity is Q1 and the equilibrium price is P1. When OPEC and its allies implement production cuts, the supply curve shifts leftward to S2, indicating a reduction in the quantity of oil supplied. This shift represents the decrease in oil production resulting from the production cut. As a result of the decrease in supply, the new equilibrium point is reached at point B, where the new supply curve intersects with the original demand curve. At this new equilibrium, the quantity of oil supplied Q2 is lower than the initial equilibrium quantity Q1, and the price of the oil P2 is higher than the initial equilibrium price P1. This demonstrates how the production cuts by OPEC Plus have led to a reduction in the quantity of oil available in the market and increase in the price of oil. Downstream industries such as transportation and manufacturing experience higher input costs due to increase in oil prices, which may be represented by an upward shift in their cost curves. This indicates an increase in production cost for these industries. Overall, the graph illustrates how OPEC plus production cuts have impacted global oil supply and prices, leading to a reduction in supply, an increase in prices, and downstream effects on industries reliant on oil as a key input. Secondly, let's delve into what are the implications of rising oil prices for inflation rates and central bank policies, particularly in the United States. The implications of rising oil prices for inflation rates and central bank policies, particularly in the United States, are multifaceted and significant. Here's an analysis of these implications. Number one is inflationary pressure. Rising oil prices contribute to inflationary pressure by increasing the cost of production and transportation for goods and service. As the businesses face higher input costs, they may pass on these expenses to consumers in the form of higher prices. This phenomenon is particularly relevant in sectors heavily reliant on oil, such as transportation, manufacturing, and agriculture. Number two is consumer spending. Higher oil prices can reduce consumers' discretionary income as they allocate more of their budgets to fuel and energy expenses. This decrease in purchasing power may lead to reduced consumer spending on other goods and services, dampening overall economic activity. Number three is central bank response. Central banks, including the Federal Reserve in the United States, closely monitor inflation trends and adjust the monetary policy in the response. In the face of rising inflation due to higher oil prices, central banks may opt to tighten monetary policy by raising interest rates. Higher interest rates can help curb inflation by reducing aggregate demand in the economy. Number four is economic growth. The impact of rising oil prices on economic growth is mixed. On one hand, higher energy costs can weigh on businesses' profitability and investment decisions, potentially slowing economic growth. On the other hand, increased revenue for oil producing regions and industry may stimulate economic activity in those areas. Number 5 is exchange rates. Rising oil prices can affect the exchange rates, particularly for oil importing countries like the United States. As these countries spend more on oil import, their trade balances may worsen, putting downward pressure on their currencies relative to oil exporting nations' currencies. Number 6 is policy challenges. Higher oil prices present policymakers with challenges in balancing inflation control with supporting economic growth. Central bank must navigate the trade-off between addressing inflationary pressure and avoiding excessive tightening that could hinder the economic recovery. And number 7 is inflation expectations. Persistent increase in oil prices can influence inflation expectations among businesses and consumers. If stakeholders anticipate continued inflationary pressure, they may adjust their behavior, such as negotiating higher wages or increasing prices for goods and services, further exacerbating the inflationary trends. Hope you liked the video. Let's unlock together your full potential and achieve remarkable success in the world of business. If you are new to the channel, do like, share and subscribe for more such content related to business and finance. Till then, goodbye everyone.